If you have over $1 million in net worth, I'm going to show you how the ultra wealthy turn their portfolios into cash flow machines and why your financial advisor will never teach you this. Most financial advisors will put you into a 60-40 portfolio and tell you to keep accumulating until you're 65. The goal is just have a bigger number on the screen. Then maybe, if you're lucky, you can start pulling 4% per year in retirement. But here's what they don't tell you. Families managing 100 million plus aren't waiting until 65. They're living off cash flow today while their wealth continues growing. So what if you're like me and don't have 100 million? Can you still do this? That's exactly what I spent 10 years figuring out. I'm Christopher Nelson, and a few years ago, my portfolio was 98% in public stocks, generating zero cash flow. Today, that same portfolio generates over $200,000 per year in cash flow and has grown by over $2 million. I'm not touching principal. I'm not selling assets in down markets. The portfolio just pays me. In this video, I'm going to walk you through the exact 3-step process to restructure your portfolio into a cash flow machine, even if you're starting with just $1 million. Now, you may be thinking, wait, I have a financial advisor. They've got me in a diversified portfolio. Isn't that enough? Well, here's the thing. Well, 2 things. First, you aren't actually diversified if more than 50% of your portfolio is in public stocks. And second, traditional advisors only know one playbook: grow the portfolio and hope that it's big enough when you need it. They measure success by your total portfolio value, not by what that portfolio actually does for you. And don't forget, they get paid whether your portfolio goes up or down. The implicit promise is always the same. If you can just get to 2 million, just 3 million, then maybe 5 million, then you can retire. But here's what happens. The dollar keeps losing value and your lifestyle keeps increasing. The goalpost keeps moving and you just keep working. So let me show you why this doesn't work for somebody with $1 million or more. The standard advice is the 4% rule, right? So on $1 million portfolio, that's $40,000 per year. After taxes, you're looking at maybe $30,000 to $35,000 annually. That's less than you probably made when you started your career. You've worked for decades, you've built $1 million portfolio, and now you're supposed to live on less than you made as a 25-year-old. You feel ultimately like you're going backwards. And psychologically, this creates an enormous weight. You're constantly asking yourself, am I ever going to have enough? Do I need 10 million, 20 million? When can I stop if I want to continue living the same lifestyle? Meanwhile, family offices operate on a completely different philosophy. They focus on income generation, not just portfolio growth. Their portfolios typically generate somewhere between 6 to 8% in cash flow annually. And here's the key. The wealth continues growing while it's continuing to generate that income. So if you want to start operating your wealth like the ultra wealthy, here's what needs to change. First, you need to stop measuring success by portfolio value alone and add a second measure: cash flow generated. Think about it. Your portfolio should work like a business. A business doesn't just accumulate value, it generates income while growing its equity. That's exactly what family offices do. And today I'm going to give you the 3 steps to start transitioning your portfolio. The portfolio that the ultra wealthy use is called the evergreen portfolio model. And before I explain how the evergreen portfolio model works, let me define a few terms really quick so that we're all on the same page. A drawdown portfolio is the traditional retirement strategy where you systematically sell off a portion of your accumulated assets each year to fund your living expenses until the portfolio is ultimately depleted. Now, an evergreen portfolio is a portfolio designed to generate consistent cash flow today, not when you retire, while still growing the principal over time. There are 3 asset categories that make up the evergreen portfolio. The first one is income. These are investments targeting regular cash distribution. The examples would be private equity, real estate, credit funds, dividend-focused stocks, income ETFs, or executing your own covered calls or option strategies. These are vehicles that are designed to generate income, and you can target 6 to 10% returns with your income investments. The second category is growth. These are investments targeting long-term capital appreciation. So for example, public equities, growth stage real estate, venture positions, right? You want to target 10 to 15% returns with your growth investments. And then finally, there's capital preservation. These are investments focused on protecting capital and maintaining purchasing power. So the example here would be treasury bonds, money market funds, inflation protected securities. You can target 3 to 4% returns with your capital preservation allocations. Now that we're on the same page, let me give you real numbers from my own portfolio. My current allocations are 47% in growth, 48% in income, and 5% in capital preservation. And my portfolio generates over $200,000 annually in tax advantage income. And during the time I've been implementing this strategy, I've grown from about $6 million to around $8 million. So I'm getting paid and building wealth simultaneously. Now, here's what's important to understand. I'm not saying you need 50% of your portfolio allocated to income investments. What I'm saying is that your allocation should match your portfolio's goal. If your portfolio's primary job is replacing active income today, then you need a heavy income allocation. I'm talking 60% or more because you need cash flow now. But if your portfolio's job is funding current lifestyle while building generational wealth, you can balance income and growth, something like I did. Or if your portfolio's job is compounding for the next generation because the income pillar already produces more than you need, you can weight growth at 60% or higher. Now, why might you want to consider this over the traditional drawdown approach? With a drawdown, you're selling assets, decreasing your principal, and you're exposed to what's called a sequence of return risks. This means that if the market drops right when you start withdrawing, you're going to be forced to sell at the bottom, and this can be catastrophic when compounded over 10 plus years. Here's a great example of the sequence of return risks. Let's say that you retired in 2009 right after the great financial crisis with a $3 million portfolio, 60% in stocks, 40% in bonds. And then let's assume that you went with the conventional 4% withdrawal rate. Your portfolio nearly tripled to $8.9 million while paying you $120,000 to $306,000 annually for 16 years. You look like a genius. But if you retired in 2000 at the beginning of a bear market, same 4% withdrawal rate, same $3 million portfolio, at the end of 16 years, your portfolio would be worth only $2.69 million. Less than when you started, while your withdrawal rates range from $60,000 to $110,000 per year. And if you add in inflation, that $110,000 a year only had the purchasing power of $70,000 in today's money. This shows you how important getting lucky is with a drawdown portfolio. Retire in a good year, genius. Retire in a bad year, and you might be going to get another job. Contrast that with an evergreen portfolio where you keep your assets, you grow your principal, and you get consistent tax advantage income today, regardless of what the stock market does on any given day. Now, how do you actually implement a portfolio like the ultra wealthy? There are 3 steps. Step 1, assess your current allocation. Look at what you own right now. What percentages are in growth-only assets that produce zero cash flow? What concentration risk do you have? For a lot of people, they have more than 50% in company stock or in broad index funds that don't generate income. And remember, index funds aren't true diversification. Step 2, develop your divestiture strategy. This is critical. You don't liquidate everything at once. Tax implications matter here, and when done wrong, could cost you 5 or even 6 figures. I recommend a systematic approach over 12 to 24 months. Use tax loss harvesting where appropriate. Take advantage of qualified small business stock exemptions if you have them. Time your sales strategically around vesting schedules in income years. Now, if you have a certified tax planner, this is a conversation you need to be having with them right now. The goal is to transition without triggering a massive tax bill all at once. And step 3 is redeploy according to your investment thesis. Here's where most people get stuck. As you free up capital, you need to know exactly where it's going. What percentage goes into income investments, growth investments, and capital preservation? What specific asset classes within each category you want to invest in and what your target cash flow needs to be. This is what I call your investment thesis, your personalized blueprint for how your portfolio should be structured based on your specific goals, timeline, and risk tolerance. So without this blueprint, you're just guessing. You might overallocate to income and sacrifice growth, or chase high yields in risky investments because you don't have clear targets. This is exactly why I host a monthly live workshop where I walk you through how do you build your investment thesis and create a systematic transition plan to an evergreen portfolio. If you're at the stage and need that blueprint, register for our next one at wealthops.io/go or click the link in the description below. Look, here's the bottom line. The traditional financial services industry wants you to believe that you need $10 million or $20 million before you can have the lifestyle that you want. They want you to keep accumulating, keep working, and keep waiting for someday. Meanwhile, families with evergreen portfolios aren't waiting. They're living well today while their wealth continues growing without worrying about when or if they'll need to be able to retire. And now you know their secret. It's not about having more money. It's about structuring what you already have differently. You have everything you need to start this transition right now. Whether you have $1 million or $30 million, the Evergreen Portfolio Framework works at your level. The question isn't, can I do this? The real question is, how much longer am I willing to wait? Because here's what I know. 5 years from now, you'll either be looking back and saying, I'm so glad that I made this shift, or you're going to be asking yourself, when is enough going to be enough? If you're ready to stop operating like the masses and start managing your wealth like the ultra wealthy do, here's your next step. Join me in my upcoming live workshop where I'll show you exactly how do you build your own microfamily office and implement the Evergreen Portfolio strategy. And if you want to understand more about microfamily offices, then check out this video where I break down the core components and how they operate. Thanks for watching. See you in the next one.